Hi, in this video I'm going to be looking at a timing screen. So again, we're going to start from the Equities Lab homepage and we're going to create a stock screener. And I'm just going to create a very simple screen. And this is not really what I'm after right now. What I'm going to do is I'm going to create a S&P 500 screen. I'm going to type in classify as S&P, choose S&P 500, and I'm just going to straight back test it. Rebalancing is weekly, it doesn't really matter. I'm going to point out one thing here before going on to creating the screen. And that one thing is that you're going to notice that if you create the screen, you might think that this screen should line up well with this brown line, and yet it actually does much better. The thing I want to point out is the reason it does much better is the brown line is a market capitalization weighted S&P 500. Put it a different way, this screen is never rebalanced. So whatever ratio the S&P 500 is at January 2010, the market caps of these companies are going to go up and down. And this brown line is always going to weight those companies in the ratio of the market cap. So you're never actually rebalancing any of those names. Whereas this green line every week reweights the 500 companies equally. And in general, this tends to do better than market cap weighting. The reason for this is you're actually selling your winners. Stocks that do well, you sell, and you buy your losers. So you're buying cheap and you're selling expensive. So this is one thing I just wanted to point out right off the bat. In fact, there's a way that you can actually see this in practice. So if you pull up SPY, so this of course is the S&P 500 ETF, and we can just pull it up in Google Finance, increase the time period to 5 years. So this is what the S&P 500 roughly looks like. If you compare this to the RSP, so the RSP is simply the equally weighted S&P 500 ETF or mutual fund, and you'll see pretty much exactly the same thing that we see in that back test, which is the orange line, which is that equally weighted performer, does a little bit better over time than the blue line. Let me just make it a little bit smaller so you can see it better. And this actually persists pretty much over the 10 years. The orange line is very rarely below that blue line. Okay, back to the timing screen. So I'm just going to minimize this. So what I really want to do here is I want to get the PE ratio of the S&P 500 as a whole. So in order to do that, I'm going to create a new tab. I'm going to call it plot underscore SP 500 PE. And in order to get the PE, what I'm going to have to do is add up the market capitalization of all the 500 companies in the S&P 500 and divide it by the total earnings of the S&P 500. I cannot simply take an average of the PEs of the 500 companies because the average of a ratio is going to be distorted by very high values. So for example, if some growth company in the S&P 500 randomly has a PE of 500 with a very low earnings year, the entire average is going to get skewed up by that one number. So what I'm going to do is I'm going to do total across. It's going to be total of market cap across, and I'm just going to put in true because I don't need to slice it by any industry, where I'm going to do classify as S&P 500. So this is going to get me the total of all the market cap of all the companies in the S&P 500. I want to divide this by the PE. So this whole thing to divide, what I'm going to do is take the main operator here, which is the total, click on it, just hit divide by, and that will put a division at the end. And again, I'm going to do total across. And in this case, I'm going to do net income. And I'm going to do net income trailing 12 months. So that's net income for the last 12 months. And again, true, and classify as S&P 500. Okay, good. So this gives me this SP500 PE variable, which should be plotted along with the strategy. Okay, so as you can see, this thing hovers somewhere between, call it 17 and 20, except over here where it spiked up to 64. I'm just going to increase the time period we're looking at, and you can see more clearly what the dynamics of this PE ratio are. Okay, so this is what the S&P 500 PE ratio looks like over time. So the sort of stable rate is somewhere between, I don't know, 17 and 20. However, just after the financial crisis, there's this big spike in it, and that's largely a function of the earnings getting completely decimated during the crisis period, right? So let's now create this timing screen. And to create this timing screen, we're going to be using a different operator. It's called the then, until, since operator. Okay, so this has a number of inputs, and the first input is what needs to happen. Then what do we hold until something else happens, and the since is just a way to implement different timing screens across different points in time. So let's do SP500 PE, and let's have this greater than, oh no, let's do less than, I think it's 17. So if this S&P 500 PE falls less than 17, then we're going to hold the S&P 500 until this S&P 500 PE is more than 18. And for this, I'm just going to put in, let's say, whatever is at the beginning of this graph. So this looks like December 30th, so I'm just going to start it, let's say, 12/1/2004. Okay. So let's run that, see what happens. Okay, great. So the backtest is finished. So a couple of things you'll notice. First of all, I want to point out that every time I run a backtest, I hit pause on the video. So the backtest typically takes about 20 to 30 seconds. It looks instantaneous on the video, but that's simply because I pause it. So the first thing you'll notice is that the PE axis is now bounded between 13 and 18. And this has to do with what Equities Lab does during periods when no equities are held. So you get this green flat line between Jan 2009 and mid 2010 because the PE ratios are sky high and Equities Lab is not holding the S&P 500, which means it's not holding anything at all, which in turn means it's holding cash. That's why you get the flat line. Now, what Equities Lab does here is they don't plot any variables that are associated with the screen, SP500PE, for example, in between these 2 points. It just goes straight as a jump from here to here. In fact, if you click here, it's not even going to recognize a point somewhere in the middle. So what I ideally like to do is have the screener hold something else, something that looks a lot like cash during that period, to get a good sense of what actually happens to the PE during this period. We know what happens. We saw it in the previous chart, but just to get a sense of what happens, as it turns out, there's a very, very nice ticker that can do that, and that is SHY. It's an ETF that holds short-term treasuries, and in reality, it much more closely mimics the holdings of cash as opposed to a flat line. So what we're going to do is we're going to put in the inverse condition here. So basically, when this is not being held, so when the SP500PE is greater than 18, let me actually start with the then condition. So we have then until since, and we're just going to put in the inverse of whatever is in that first line. So when this thing is greater than 18, then we're going to hold the SHY until the S&P 500 PE drops below 17, right? So when it's less than 17, we're going to stop holding SHY, and we'll have that same December 1st date. And I'm just going to back test that. Again, this will take 20 to 30 seconds. I'm just going to pause the video. Okay, so as I mentioned, it's back testing. However, this is going to generate an error, and then I'm going to point out why it generates that error and how to fix it. As I mentioned, there's this error. The SP500PE does not exist for this security. The reason that happens is the since command truncates our data set at that date. And this is especially problemsome for this SHY ticker because it cannot compute the trailing 12-month net income if you're truncating your data set at December 1st, 2004 in early 2005. So what we have to do is simply just have this go back a little bit further, and it should work. So we're just going to start this rule way before this strategy is even started, and we're going to back test that, and hopefully that's going to work. And there you go. This is what the back test looks like. You have the screener in along with the markets, and occasionally you have periods where it's not in there. Instead of being completely flat, you just have a line that's pretty much flat but is actually in the SHY. And the screener does pretty well, and you'll notice that in recent periods the S&P 500 PE is a little bit higher, so it's currently in cash. But overall, this timing screen seems to do pretty okay.